Hey everyone, so as we step into 2025, it's the perfect time to reflect on everything that we experienced in 2024 and also what lies ahead. From Fed moves to election-driven uncertainty, 2024 definitely kept us on our toes. So what we're going to do in this video is unpack the highlights from last year and also set our sights on opportunities here in 2025. So US stocks soared over 20% in the last year, led mostly by AI-driven mega tech names that we all know. But towards December, towards the end of the year, the Federal Reserve came out and signaled that they're not quite ready to cut rates as aggressively as we would have hoped, aligning with the, quote, higher for longer narrative in terms of interest rates. And Treasury yields really danced to their own tune throughout the year, swinging wildly after 100 basis points, closing around the year at 4.58%. So now we zoom out and we look at asset performance over the past 12 months. So there's really a clear story here. Gold was obviously the star performer. As you can see on the chart, they had the best performance in the year. And US equities surged ahead, outperforming both European and emerging market equities. Now on the flip side, bonds like the German 10-year Bund and the US 10-year Treasury faced challenges, struggling with negative returns amidst rising interest rates. Remember, interest rates go up, bond prices go down. Energy markets told their own story. Brent crude saw significant fluctuations throughout the year too. So last year really showcased how diverse market forces can impact different asset classes. From gold's strength, as we saw in the chart there, to even the bond market's challenges, it's an important reminder that we've got to be diversified. All right, so let's talk a little bit about the moves that we made in the fourth quarter of 2024 specifically. But before we jump in, as always, quick reminder, little disclaimer here, no two financial situations are the same. Individual results will always vary. So use this commentary as perspective, not personalized advice. Always tailor your strategies to your own unique goals. So that aside, let's set the scene here. After the US presidential election last November, the markets felt like really a tightly coiled spring. So much of that pent-up energy waiting for clarity on who's going to win the presidency. Businesses were ready to act, investors were eager to make moves, and we really saw that as a chance to lean into the momentum. But it wasn't just the election that drove a lot of the optimism that we saw last year. Consumer spending specifically held up surprisingly well. Economic data started to trend positive, and even the inflation pressures that we would have expected seemed to cool off. It was kind of like threading the needle. Things were strong enough to inspire confidence, which led to new highs in the stock market, but not so strong as to set off any of the inflation alarms. What we did and why we did it. So one of the big moves we did, we added a 3% overweight to stocks, and that took our overall overweight to 4%, aiming to ride a potential, post-election risk-on type of rally into year-end. Really, to compound that, historically, November and December have been really solid months for equities, so we positioned the portfolios to really take advantage of that seasonal lift, which did happen. Number two, we also focused on US stocks with momentum specifically. So while international markets had some appeal, the US looked like a stronger bet, especially for companies already showing, solid momentum. And number three, we introduced a tactical allocation to gold. Now, gold might not be the first thing that comes to mind, in a stock market rally. It's tended to be viewed as more of a protection piece. But hear me out here. Central banks have been snapping up gold, and with all the geopolitical uncertainty out there, especially with future tariff things that I'll get to here in a minute, gold felt like a smart diversifier, and obviously that panned out as well. And number four, we increased credit risk in bond-heavy portfolios for that fixed income piece. We swapped out longer duration investment grade bonds for shorter duration, high yield, and also convertible bonds. Why did we do this? Those type of bonds carry a little bit more risk, but they offer equity-like upside, which felt like a good fit given that environment that we were in at the end of the year. So why did we make all these moves? The markets were really holding an uncertainty discount, I would call it, meaning prices were held back by hesitation from investors. But with the election behind us, then we believed that those discounts could start to unwind, and they did. And in a resilient economy and a Federal Reserve likely to ease rates further, we felt that it was a perfect time to lean into those risk assets. So ultimately, these moves were all about capitalizing on opportunity while staying thoughtful about, balancing risk and reward. So that kind of strategic positioning is really what helps us navigate evolving dynamic markets with confidence. So what does the future hold for the markets, and really what trends should we be keeping an eye on for this year? So AI, artificial intelligence, has ignited a massive investment wave with the so-called, magnificent seven tech names, Alphabet, Apple, NVIDIA, names that we all know leading the charge. Their R&D department spending has been far outpaced by even the US government's investment in innovation, as you can see on the chart here. But what about valuations? On the other chart, despite concerns of overinvestment, are we pumping too much money into this possibility with AI? The market cap to free cash flow ratio for these companies shows that they're not overextending compared to broader market trends. That gives me confidence. This really suggests that these mega cap firms are actually navigating this AI revolution with discipline. So now I want to talk about why we're still big on US stocks. Really, US stocks have been crushing it over the past decade. They have outperformed the rest of the world by a mile. The red line on the left of this chart is running laps around the yellow line. So the question is, what's driving it? On the other chart, we can see strong corporate earnings, and it's that simple. The only thing the market cares about is future corporate earnings. And US companies have consistently delivered. And that resilience gives them all an edge. Sure, global markets have potential, but when it comes to innovation and adaptability, the US is leading the pack, and we expect that to continue. So what's the bottom line? We believe that US equities are well positioned to maintain their leadership, creating ongoing opportunities for investors. All right, so now let's tackle interest rates. A year ago, everybody was bracing for rate cuts, right? But the Fed this past year threw us a curveball, pivoting later in the year to a, quote, higher for longer stance. And honestly, it made sense. So despite rate cuts of, 1% or 100 basis points last year, inflation really cooled off. And while growth stayed strong, well above historical trends, the Fed held firm. And essentially they recalibrated expectations and really leaned against the market calls for sharper rate cuts. By the end of the year, the market had, I think, largely aligned with this new reality of higher for longer. Now, as we head into 2025, the higher for longer framework has created really a unique environment. Volatility's up, but with volatility, we got to remember, also comes opportunity, especially in, fixed income. For investors willing to navigate this very unique, unusual backdrop, there's plenty of room to play smart still. So right now, equities have rallied on the back of resilient growth and a higher for longer environment. But, we got to remember there's a couple things that could cause us to adjust this, risk on stance within the portfolio positioning specifically. First, the S&P 500's price to earnings ratio has climbed alongside Fed rate expectations. So if valuations keep stretching while rates remain high, we might hit a tipping point where stocks start to look, in my opinion, less attractive. That PE ratio gets too high. And second, we also want to look at gold. It's the performance relative to real yields suggests that investors are already hedging against these potential risks like rising long-term bond yields or potential geopolitical uncertainty with the new administration and potential tariffs and all that good stuff. But for now, I'm going to say we're remaining cautiously optimistic. These dynamics, in my mind, really underscore the importance of flexibility. Gold in particular stands out as a potential diversifier if the tide starts to turn. I'm going to put a slide on the screen here, and I know there's a ton on the slide, but stick with me and try not to jump ahead. So what we're going to do is break down this chart like almost a choose your own adventure story for the markets. So let's do it. First big question, all the way to the left. Will growth be structurally weaker than before the pandemic? Best case? No, it won't. That's the scenario we all want to see, right? That's where the economy keeps enough momentum to avoid a long-term slowdown. But even if growth isn't structurally weak, The next big question is, will there be a recession in the next 12 months? If no, we get to the dream scenario. We've got easing supply constraints, that boosts growth, and then picture this, AI and productivity gains. So with companies getting more efficient because of that, that supercharges growth even more, inflation cools off, the Fed cuts rates, and both stocks and bonds rally. Sounds great, right? But if yes, we hit what I would call a rescued hard landing. Rate hikes take a bit of a bite out of growth, but here's the silver lining. The inflation drops below target. The Fed steps in with big rate cuts after big hikes, which helps bonds outperform and eventually gives stocks a chance to rebound. Now, big question is, what happens if growth is structurally weaker than before the pandemic? So we go the other way now. That's when things get a little bit trickier. So if it's yes, that poses the next question. Will overall yields be higher than what the market's actually pricing in now? If no, we're in for subdued growth, stubborn inflation, growth crawls along, inflation refuses to fully cool, and rates stay higher for longer, making it tougher for both stocks and bonds to shine. Now, if yes, yields are higher, and yields are higher than what the market is pricing in, then we've got to ask, has the market overpriced these AI-based valuations? Now, if they have, then welcome to high rates and hard landing. Inflation stays sticky, the Fed is forced to hike further, and growth slows, and stocks and bonds both take it on the chin and take a hit. Now, if not, and AI efficiency is being appropriately priced into these stock prices, even if growth slows, U.S. companies show up strong. Profits hold steady, the AI rally keeps lifting stocks, and that makes U.S. equities a bright spot. So that would be proof that solid fundamentals can still win even if we do have a softer economy. Now, this decision tree helps us see how the pieces could really all fall in place, which is why I show it to you. But the key takeaway, the best case scenarios are possible, but they depend on growth, resilience, and most of all, inflation still cooling. So staying nimble and adaptable is going to be critical to navigating all of this year. Now, in the ultra near term, I want to talk a little bit about the two key dates that could set the tone here in early 2025. So first up, we've got CPI data on Wednesday coming out, Wednesday, January 15th. Why does this matter? The Fed has been hitting the brakes on rate cuts, blaming, the recent bounce in inflation here. So while most think that the uptick is, quote, just a phase, we really need hard data to back that up. So when that number comes out, it's positive, the CPI comes in cooler than expected. That would be a green light that inflation is easing back to that long-term Federal Reserve 2% target, which could and hopefully reignite hope for more rate cuts. Now, that number would be negative if CPI runs hotter. That might mean that inflation's making a comeback, and that would push yields higher and likely take stocks down a notch. Now, next up, the Fed decision on Wednesday, January 29th, so two key dates here in January. Why does that date matter? Let's face it, this bull market has leaned heavily on rate cuts. So if the Fed even hints at pausing, it could really throw markets off balance. So it would be positive if Powell, head of the Federal Reserve, reassures us that rate cuts are still in play for the remainder of this year. Markets will likely breathe easy. Now, it's negative on the other side if the Fed signals any sort of pause in cuts. That sentiment could take a hit and it would drag stocks with it. Now, these two events this month in January are really make or break moments, in just in the near term. We're going to keep our eyes on the numbers and the Fed's tone, and that's going to give us a much clearer read on really where we're going to be headed next in the short term here. And that wraps it up. So I know this video was a little bit longer than normal. I hope you enjoyed it. That would be our review of last year, 2024, and our outlook here in the new year. If you're a client, you should have already received your personalized performance report and net worth progress reports from last quarter. As always, if you have any questions at all, please do not hesitate to reach out. I'm here for you. And as always, stay the course, stay on point, And quick heads up, if you are a client, I will be connecting with many of you here in the coming weeks to get those tax returns squared away. So until then, take care and talk to y'all soon.